You want to shut off that spigot of nonstop money to the military-industrial complex, well, let silver go to the moon. If not, these banks who are stupid enough to maintain the largest concentrated short position in any commodity ever traded, this is what happens. And so these countries understand what we're up to, and they're using the suppression against us. We will wake up one morning and see silver go to the moon. So if someone said silver could go to $500, are they stupid? Or are they just actually speaking in terms of real geological principles?
While gold continues to set new records, silver is trailing, with a modest gain of just over 12% in 2025, significantly lagging behind gold's performance. The gold-silver ratio has recently surged to 104 to 1, meaning it now takes 104 ounces of silver to purchase 1 ounce of gold. This is well above the historical average of 60 to 1 and higher than the 1991 peak. Historically, such extreme ratios have often preceded significant surges in silver prices, as seen in March 2020, when the ratio hit 123 to 1, followed by a rapid doubling of silver's value in just 5 months. Experts such as Keith Neumeier suggest that the current market conditions mirror those of previous silver rallies, where gold led the charge and silver eventually caught up. A significant factor behind silver's underperformance in the market is the strategic price suppression orchestrated by major Western financial institutions. According to Andy Schectman, CEO of Miles Franklin, a small group of commercial banks holding concentrated short positions has kept silver prices artificially low for years, serving the interests of certain financial and political sectors. This manipulation has delayed the true recognition of silver's value as a precious metal and an industrial commodity. However, emerging economies, particularly China, India, and Russia, have been keenly aware of the distortions in the market. These nations have quietly acquired silver at suppressed prices, often bypassing traditional exchanges and securing direct deals with miners in Latin America and Africa. In doing so, they have accumulated doré bars and silver concentrates, sometimes at premiums, reflecting a strategic understanding of silver's value that is not yet fully reflected in the global market. This deliberate accumulation further demonstrates the widening gap between paper markets and the physical silver market. While the Western financial system continues to manipulate silver's price, countries like China have aggressively secured supplies for strategic industries, such as solar energy and electronics. As global confidence in fiat currencies wanes and systemic financial risks continue to rise, the true value of silver, both as an industrial metal and a store of wealth, is likely to be realized. Now, we present the clips from Andy's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
First of all, the gold to silver ratio has only been this high maybe 2 or 3 times in history, and it represents what I believe silver does as the most undervalued asset on the planet, 100%. And you're right. Typically, gold will go first, silver will lag behind it, usually during the initial phase. But then typically slingshots and catches up, delivering 2 to 5 times greater returns if history is any guideline. The historic average for 5,000 years was 16 to 1, 16 ounces of silver for every 1 ounce of gold. That was the geologic ratio and the price ratio for over 5,000 years. When we hit the Industrial Revolution, man's ratio, not God's ratio, the mining ratio of 16 to 1, has been since then roughly 42 to 1. That's been the average price ratio. But my buddy Keith Neumeier, who is in your neck of the woods up there in Vancouver and the CEO of First Majestic, has told me many times, both publicly and professionally, or personally rather, that the real ratio right now is 7 to 1, that silver is found in nature like your skin is epidermis, and silver is found very near the surface. It's called epithermal, and the big deposits were found decades ago. With the current level at 100 to 1, you're talking maybe one of the greatest opportunities I've ever seen. Anytime silver gold ratio gets above 80 to 1, silver is poised for a breakout. I do believe we will see that breakout. In my belief, am I able to share my screen with you? I want to show you why I think this was let me open this up. This was a presentation I did at Rick Rule's. Yeah, here it is, at Rick Rule's conference. Let me share my screen here. This is can you see that? This is a presentation I did at Rick's conference last year. So this is all last year. But that S.2768, a Senate subcommittee bill in 1942. And if we just read the first paragraph, the present consumption of silver for war purposes is at the rate of about 100 million ounces a year and is growing rapidly. According to the War Production Board, it's only a matter of months before war demands will have increased sufficiently to require at least 200 million ounces of silver per year. So silver used to be openly talked about in its military capacity forever. So here are last year's supply-demand numbers, which show a 265 million ounce shortfall. All right, here's the supply, or the demand, right here, okay? Here's the demand. Industrial, 9%. Electrical and electronics, 9%. Photovoltaics, 20%. That's solar panels. Brazing, alloys, and solders, 3%. Other industrial, 9%. Photography, -3%. Jewelry, 4%. Silverware, 7%. What are we missing? Where's military? Why is military not in there? And maybe this is why silver hasn't performed. This is the COMEX market. The red line represents the biggest 4 commercial banks that are short silver. The green line represents the 4 plus the other 4 big banks. These are 8 Western commercial banks that have the largest short position on silver of any commodity they trade. Now, why the hell would 8 banks, when you have India importing 900 million ounces in the last 5 years, when you have Russia openly saying we're going to add it to our strategic stockpile, when you have China right now, which is the second largest producer in the world, they think they're number 1, but let's just call them the second largest producer in the world. And ask Keith Neumeyer about this. Ask Sean Kuhn about this. They're flying. Sean told me to my face, Andy, they are flying all around, and he's the Dolly Varden CEO. Or they're flying all around Latin America, in particular Peru, going right to the miners. Remember, the second largest producer in the world. What the hell do they need to do this for? They're going to the miners directly and saying, listen, we'll take your doré and your concentrate, which is crudely refined doré bars before they're sent for further refining and purification, and the sludge, the concentrate. We'll take it all. We'll pay double what the West will, and then we'll send it back to China for further refining. They're using the suppression against us. They're standing for delivery in London. They're standing for delivery on COMEX. They're standing for delivery in Shanghai. But you have 8 banks suppressing the price of silver, and this is what happens when 8 banks suppress the price of silver. These are the London vault totals. So let's suppress it, and the world gets wise to it. They are sophisticated, coordinated, motivated, wealthy, and they are standing for delivery, draining the LBMA. These numbers are below now. They're about 760 million ounces, not 800, of which over 500 belong to the ETFs. They only have 250 million ounces or so available, but they're trading 2.9 billion ounces a day. Are they out of their frickin' mind? 2.9 billion per day, 3.5 times global mine supply against a float that's 10 times less than that. And this is because the military-industrial complex needs to make high-tech weapons, doesn't want the world to know about it, suppress the shit out of the price. They own BlackRock, as an example, who is the primary custodian along with JP Morgan for SLV. They just took over, both of them, JP and BlackRock, as the primary custodians of GLD, SLV and GLD, massive holders in PSLV, and they own the majority also of the military contractors, almost all of them. And so they make the weapons, high-tech weapons, to sell around the world, and then you watch them blow up in places like Ukraine, and then who gets the reconstruction contracts? Oh, that's right, it's BlackRock. BlackRock gets the reconstruction contracts. So if you want to shut off that spigot of nonstop money to the military-industrial complex, well, let silver go to the moon. If not, these banks who are stupid enough to maintain the largest concentrated short position in any commodity ever traded, this is what happens. And so these countries understand what we're up to, and they're using the suppression against us. We will wake up one morning and see silver go to the moon.
The global monetary landscape is profoundly transforming, with gold reclaiming its historical role at the center of international finance. This shift, largely unreported in mainstream media, represents one of the most significant monetary developments of the 21st century. Since November 2024, the United States has become a net importer of gold, marking a dramatic change in global gold flows. Historically, the U.S. has been a major exporter of precious metals, but now, experts describe the gold inflows as unprecedented. This change reflects a growing distrust of the dollar and an increasing preference for gold as a stable asset. Andy highlights that this movement aligns with a broader trend where central banks significantly increase their gold reserves, viewing it as a safer store of value amidst rising global uncertainties. As central banks across the globe accelerate their gold accumulation, the implications for the global financial system are profound. This surge in demand places significant pressure on gold supplies, contributing to rising prices. Countries, particularly within the BRICS alliance, have been vocal in their efforts to diversify away from the US dollar, fueling further interest in gold as a reliable and tangible asset. The US, historically the central pillar of global finance, now faces a growing challenge as the international community pivots toward gold as a hedge against economic volatility and the diminishing dominance of the dollar.
What we are seeing is since November, the United States has become a net importer of gold. North of 60 million ounces that we know of have been delivered into the COMEX. Gold is the only other tier one reserve asset in the world, according to central banks, and that was reclassified by the Bank of International Settlements. It's U.S. Treasuries, and that's where it's been since the end of World War II. And since 2019, now gold. Now, let's just sidestep the fact that that could have been an error. Maybe it was, maybe it wasn't. We've seen tremendous deliveries into COMEX, more so than we've ever seen. And we've seen most of it coming from the LBMA in London, where they are a T+1 settlement exchange, where if you stand for delivery on your trade, it's T+1 is a settlement. On the third day, the metal should be moving. So much has come out of the LBMA. I think they've spooked the LBMA because of their rehypothecated position. I'll explain that in a moment. They've now all of a sudden gone to T+8 weeks. And they say it's a shortage of trucks and manpower. So the Bank of England evidently is short on trucks and can't make the delivery demands that are set upon them. To give you an idea, they have somewhere in the neighborhood of a float of 36 million ounces of gold, but yet that's standing behind somewhere in the neighborhood of 280 or 300 million ounces in open spot contracts. In other words, if every one of those contracts stood for delivery, over 300 million ounces roughly, there's only 36 million ounces for delivery. That's a problem. And on silver, the LBMA has, no, it will be 260 million ounces in that neighborhood of silver that is unencumbered, right? They have 780, 760 total on the LBMA in their vaults, of which over 500 belongs to the ETF. So about 260 million ounces are supposedly available in London, but they trade 2.9 billion ounces per day, 3.5 times annual global mine supply. Again, if everyone stands for delivery, we got a big problem. And so all of a sudden they've gone from T+1 to T+8 weeks, which is a big issue because they say it's just a shortage of trucks. Imagine you have a multinational jewelry business and you own these contracts so that you can fabricate your jewelry. Sorry, guys, we apologize. I know you're expecting your metal, but it's 8 weeks because we don't have enough trucks. This is almost the form of a default. Most of that metal is coming into the United States. As I've mentioned, we've become a net importer of the only other tier one reserve asset next to U.S. Treasuries, which the world seems to be shedding. The central banks are selling treasuries and buying gold, which has doubled the performance of the 10-year Treasury since the turn of the century, doubled it with no counterparty risk. In other words, it can't be sanctioned, can't be taken from you. And what I find really interesting above all else is the tweet that Trump came out with on April 20th, 2 days ago at 3:09 p.m. on Truth Social. He says, "The golden rule of negotiating and success, he who has the gold makes the rules. Thank you." Interesting. U.S. has become a net importer. J.P. Morgan delivered $4 billion of gold the end of February into COMEX for a customer. Who's that customer? Could it be the Treasury? Could it be the Fed? Could it be Warren Buffett? We saw the largest deliveries into the COMEX in its history over the last several months. And so as gold is coming in, which is the only other tier one reserve asset, you have all sorts of noise around the periphery, whether it be gold is held on every central bank balance sheet, including the United States, in something called the gold revaluation account. You can't make that up. When Nixon closed the gold window in 71, he revalued gold. It was at 35 bucks. He revalued gold the next year, 72 to $38, which means he devalued the dollar. And then the following year, 73, revalued it to 42.22, where it stayed on the balance sheet ever since. In 33, over my shoulder, when Roosevelt confiscated gold, it was at $20 an ounce. He paid everyone $20.67. Well, if eggs are a nickel for a dozen back then, 67 cents is good. And then he devalued the dollar immediately by 40%, in essence, revaluing gold at 35 an ounce, where it stayed until Nixon closed the gold window in 71. Gold is the only other tier one reserve asset next to what? U.S. Treasuries, which everyone is selling. So how do you inspire confidence? Well, you issue treasuries backed by gold. Give it another year and 3 months before you issue them. Keep letting gold rise little by little by little, which isn't getting noticed by anybody except guys like you and me. And then maybe we'll revalue it market to market at some point, or even higher, and peg it to a new system where treasuries are redeemable in gold. Now, there's a lot of fact in what I just said, a little bit of supposition, but what I will tell you is that the deliveries into COMEX are real. Whatever they want to tell us about that being a glitch or an error, may be true, maybe not. Maybe they just panicked and told everyone, we got to cash settle you for now. This is a problem. I don't know what they did. And maybe it really was a glitch. But the fact that the United States, first time in my career, has become a net importer of gold, the only other tier one asset in the world, all this gold is flowing in, and you have all of these entities at high levels talking about revaluation, pegging it to a treasury system, redeeming it that way. All of these things are coming together at the same time. And here we have gold at almost 3,500 bucks an ounce, and there's not a damn person in the mainstream who's talking about it. Gold is not reacting to something. It is being quietly reintegrated into the fabric of the new monetary system. That's my belief, and that's why it hasn't caught the attention of the mainstream yet.
Gold's recent surge has once again affirmed its status as a safe haven asset in times of economic uncertainty. However, history suggests that silver, often overshadowed by its more renowned counterpart, could soon rise to the forefront. While gold has been on an impressive run, climbing by 41% over the past year and delivering a 113% return this decade, silver tends to follow suit, often catching up after gold's rally, sometimes even outperforming once markets stabilize. The precious metal reached a record high earlier this week before pulling back after U.S. President Donald Trump tempered his rhetoric on trade and the Federal Reserve took steps to manage interest rates. Despite these fluctuations, gold remains a top choice for investors seeking protection against geopolitical and macroeconomic turmoil. Yet, with silver's unique hybrid nature, both a safe haven asset and an industrial metal used in electronics and solar energy, it is poised to shine once the global economy begins to recover, potentially outpacing gold. That's it for today. Share your thoughts on Andy's analysis in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.